Back to the markets, yeah. Kicking off 2020 the right way. The Dow poised to jump more than 100 points in the first day of trading of the new decade. This after the record year on Wall Street. All three major indices, let's show you again, this does not get old, up over 20%. The Nasdaq up 35.25% last year alone. Let's bring in CFRA Research Chief Investment Strategist, Sam Stovall. So we just showed you the numbers for last year. They're impressive. I mean, what happens after that?
How do we follow, right?
Can you follow that?
Absolutely, and history reminds us that actually good years tend to follow great years, that of those times that we've had the market up by 20% or more, the market was then higher 80% of the time, with the average gain being about 10%.
So we could have another 10% gain this year? We
could have another double-digit advance, certainly not as strong as the near 30% climb that we posted in 2019. But, you know, I think people could end up being relatively happy.
You know, most of the investment banks, and this is not a shock, but most of the investment banks are expecting, you know, a mild-mannered 2020. I don't think I've ever seen investment banks saying it's going to be down. You know, there's a lot of other indicators that I look at that show me that the market is totally heating up, like IPOs, for example. And IPOs in 2019 weren't that, I mean, they weren't huge. You know, in terms of like looking back at 1998, 1999, when they were off the charts, you know, we're not seeing that much flow in IPOs. What other indicators, Sam, do you look at in terms of how a market is heating up or not?
Sure. Well, also, you have to remember that when you're dealing with an entire calendar year, you have to remember that there are going to be pullbacks and maybe even corrections along the way. Pullbacks, 5 to 10% declines occur basically every 9 months. Right now, I'm looking at the price to earnings ratio on forward 12-month earnings, and we are above 19 times. And the last time that occurred was early 2018, just before a correction of about 14%.
That's right.
So, you know, something we have to be aware of, that sometimes the market does reset the dials before moving onward.
But you know, the multiple on earnings definitely correlates to some degree with interest rates. With interest rates as low as they are now, in our joint history on Wall Street, we know that should mean higher multiples, correct?
It does, but the ratio between, or actually the sum of inflation, of interest rates and the PE ratios right now implies anywhere from a 9 to a 12% overvaluation, whether you look to median or mean. So looking at, you know, basically saying what is a normal situation. Yes, we can be in an overpriced situation for a while. We then digest, we then move forward. But lower rates, you know, it's like a seesaw. The lower the rates, the lower the inflation, the higher the valuations can be.
Right. Should be.
Should
well, no,
be.
I mean, that's the
yeah,
way that
well, should be and
value.
Typically are.
We're also in an election year. Typically, election years are positive years for stocks, but a Republican is the incumbent, and that means it's even better.
Absolutely. Well, the third year is the best by far because everybody anticipates that the incumbent wants to get reelected, so they'll do whatever they can to stimulate the economy. And by the time the voters go back to the polls, the economy is doing really, really well.
Makes sense.
So the fourth year, the election year we're in right now, the market gains about 6.5% and is up around 80% of the time. But every time a Republican has gone for reelection, the market has been higher. Not a guarantee, but simply a factoid. So that could be a repeat this year as well.
As you said, good years follow great years. And I'm just thinking, all those investors sitting on the sidelines saying, it's so high, when do we invest our money? When do they invest their money?
Sure. Well, I think anecdotally there are just so many people out there that are worried. They're sort of sounding like Fred Sanford saying, Elizabeth, it's the big one. So they're waiting for some big decline to occur. And I think because they're going to be on the sidelines, we could end up seeing a move into the markets.
Okay. President, go ahead, Jeff.
I was going to ask, where are the opportunities? I mean, I know they're, you know, small caps were beat up a little bit early in the year, started to improve. Emerging markets, you know, they got beat up as well. Are those different classes that you think that people can really find and find some extra yield there?
Well, in terms, I like to say that fundamentals tell you what, but technicals tell you when and how far. And right now, the fundamentals are certainly saying, absolutely, small caps, developed international and emerging markets look very attractive. While the S&P is expected to gain only about 8% in earnings this year, developed international is supposed to be 10.5%, and emerging markets at about 13%. Small cap stocks are expected to be seeing growth in the 20% area. So when you look to valuations and potential, then yes, there's certainly an opportunity, but I don't think a lot of people are going to be willing to be the first ones to jump in.
Does anything look bad to you?
Does anything look bad to me other than myself in the mirror?
That's not true, but that
we call that fishing.
Oh, yes, you're right, you're right. So I would tend to say that, when you look to the decades, the interesting thing is that typically the three best performing sectors within one decade tend to be the laggards in the next decade, and then the worst performers are the better ones. Energy and materials are those that were by far the worst performers in the 2010s, whereas you find tech, consumer discretionary being among the stronger ones.
So I think that was exactly my question. When you're talking about emerging markets, in my head, that really has a lot to do with China, with commodities, and how commodity prices are gone, et cetera. And in fact, if you think that China's slowdown in the last 2 or 3 years has occasioned the fall off on oil prices, for example, or other kinds of commodities, and rising supplies, I mean, aren't we maybe going to look at a reversal of those trends for the next decade? That's possible, right?
Yes. So I guess the question when someone says what's a good opportunity or whatever, the next question should be over what time frame.
Yeah.
So if we're looking for the next 6 to 12 months, then I would tend to say the trend is your friend and focus on that kind of momentum, earnings growth, et cetera. If you're looking for long-term investment opportunities, Danny and I were talking in the green room about value stocks and how an adage that I like to look at is the barbell portfolio. Pick the 10 best and the 10 worst sub-industries from the S&P from the prior year, and as a portfolio that tends to beat the market about 80% of the time.
I also want to talk about the economy, because 2020 obviously in focus with the election. The president is running on this booming economy, but some of his opponents are planning huge spending increases, including Medicare for all. So what will the markets look like to you when we have more of a sense of who the Democratic nominee is?
Well, I think that, first off, we have to acknowledge that most economists are not calling for recession. We're looking for 2+% growth through each of the quarters of 2020. We're also, I like to look anecdotally at housing starts. Every recession since 1960 was preceded by a double-digit decline in housing starts. Right now, we're looking at a near double-digit gain in housing starts year on year. So, what is really going to be causing the trigger? I think that the House will remain Democrat, the Senate will remain Republican, so technically whoever becomes the president will not have the opportunity to push through Medicare for all should the Senate remain Republican held. But the way it looks right now is that I think that the current administration would be hard to defeat, but the market can also give you an idea. Performance from July 31 through October 31 has correctly indicated who will get elected or reelected 90% of the time.
Oh, wow. So 2019's July 31st to October 31st?
2020's.
Okay.
So take a look at the market, July 31 through October 31. In 2016, it was down, implying that the incumbent party would get replaced. In 2012, it was higher, implying that the president would get reelected.
Unbelievable. One more for you. We'll soon see earnings coming in for the last quarter of last year. What sectors do you expect to be the strongest in that final quarter? And then how are they going to do in 2020?
Right. Well, financials is expected to do very well. We're also looking for an improvement in healthcare and, oddly enough, utilities. What is a little disconcerting is that right now Wall Street estimates are calling for a near 2% decline in earnings. That would be 2 successive quarters of earnings declines, which is the unofficial definition of an earnings recession. And 3 out of every 4 earnings recessions have morphed into economic recessions. The last time it happened, we just blamed it on energy and everybody was happy. But who knows what will happen this time around.
So you're at 2% roughly for growth going forward. Some economists have been upping their estimates to 2.5%, some thinking even that's sort of conservative. Do you disagree with that?
I don't disagree with it. I think the question is, if the current forecasts are wrong, are we over or underestimating them? And I think just based on market action, it would imply that we are underestimating economic and earnings growth. What's the old saying that prices lead fundamentals? And so because the market has been doing so well since middle of October, I think the implication is that we are underestimating what's likely to happen in this calendar year.
I feel like this is all good news. Sam, so good to see you.
Yep, nice to be here. Thanks.
Happy New Year.
Thank you. Happy New Year.
You too.
All right, coming up, the roaring